The real estate market has long been regarded as a solid investment option, offering the potential for steady income, capital appreciation, and portfolio diversification. However, investing in real estate is not without its challenges, and one significant factor that can impact the real estate market is the interest rate environment. As interest rates begin to rise, potential real estate investors must carefully weigh the pros and cons of entering the market. In this video, we will delve into the pros and cons of investing in real estate during a period of increasing interest rates. Make sure to subscribe to our channel now and press the bell icon to get regular updates. Welcome to Money Mindset. Let's get started. Pros of investing in real estate in a rising interest rate environment. Number 1. Potential for lower purchase prices. When interest rates rise, it's possible that some people who are interested in purchasing a property will get the impression that now is not a good time to do so. This is due to the fact that rising interest rates result in increased costs associated with borrowing money. As a consequence of this, fewer people may be interested in purchasing homes, which can lead to a decrease in the demand for real estate. When there is less demand for a product or service, prices of related goods and commodities tend to fall. On the other hand, those who put their money into real estate investments may stand to benefit from the current market climate. This is due to the fact that when prices of properties are lower, there is typically a better opportunity to buy homes at prices that are more favorable. As a result, an investor who purchases real estate when prices are at historic lows stands a greater chance of realizing a profit in the future when conditions in the real estate market improve. This is what is referred to as increasing one's returns on investment. It is similar to purchasing an item at a reduced price with the intention of reselling it at a greater price at a later time. Number 2. Higher rental income. If interest rates continue to climb, it may become more difficult for some individuals to satisfy the standards necessary to qualify for a home loan. It is probable that as a direct result of this, they will decide that renting homes rather than purchasing them is the best option for them. It is possible that there will be an increase in demand for rental dwellings as a result of the decision that individuals make. It is possible that real estate investors will be able to negotiate higher monthly rent payments from tenants as a result of the increased demand for rental housing. As a result, an opportunity for improved profitability may become available to investors in the market for rental property as a result of rising interest rates. Number 3. Inflation hedge. People often think of real estate as a smart way to protect themselves from inflation. When inflation happens, things get more expensive over time. This can cause the value of your money to go down. But inflation has shown that the value of real estate tends to go up as well. Because of this, real estate is a good way to protect your money from the harm of rising prices. Worries about inflation are even more important when interest rates are going up. During these times, real estate can look even better. Along with inflation, the value of real estate has usually gone up over time. This means that if you buy in real estate, you might have a better chance of keeping the value of your money as prices go up. Number 4. Portfolio diversification. Diversification is an important concept in investing. It means spreading your money across different types of investments. This helps you reduce the chance of losing a lot of money if one investment doesn't do well. Real estate is a way to diversify your investments beyond just stocks and bonds. When you invest in real estate, you're putting your money into properties like houses, apartments, or land. This is different from buying stocks or bonds, which are pieces of companies or loans. By investing in real estate, you can have a mix of different kinds of investments in your portfolio. One great thing about real estate is that it can behave differently from stocks and bonds. For example, even when interest rates are going up, the real estate market might not react in the same way as the stock market. This means that if one part of your investment portfolio, like stocks, is going through a rough patch, the real estate part might still be doing okay. Now let's talk about some of its major disadvantages. Cons of investing in real estate in a rising interest rate environment. Number 1. Higher financing costs. Putting money into real estate at a time when interest rates are expected to rise is potentially a poor financial move. This disadvantage is related to the cost of obtaining money, which rises to a higher level if interest rates are increased. When interest rates rise, mortgage rates often rise. which can have a significant impact on the overall cost of purchasing a property in the market. If a real estate investor needs to borrow money in order to pay for a transaction, there is a possibility that they will be unable to generate as much profit because the interest rates on loans are higher. When interest rates are higher, the potential benefits of using leverage, sometimes known as investing with borrowed money, may not be as great as they otherwise would be. Number 2. Reduced property value appreciation. When interest rates go up, it's possible that the initial cost of buying a house or some other kind of property will go down for a while. On the other hand, this may also have an effect on the rate at which the value of the property appreciates over the course of time. People who are considering making purchases might have second thoughts about entering the market, which could decrease the rate at which prices continue to grow, or perhaps cause them to remain steady. This would have an impact on the economy. The amount of money that real estate investors make from their investments may be impacted as a result of this, particularly if they are banking on the value of the property increasing by a sizable amount. Number 3. Vacancy and tenant issues. If mortgage rates were to rise, it is possible that some people who were considering purchasing homes would opt to rent one instead. Because of this, the demand for rental houses can rise as the number of people who wish to rent homes increase. Nevertheless, the state of the economy can also have an impact on the market for rental properties. Tenants may have problems making their rent payments if the economy continues to struggle as a result of the increase in interest rates. Because of this, there may be an increase in the number of vacant homes, which will make it more difficult to maintain and manage rental properties. Number 4. Opportunity cost. When you invest in real estate, you have to spend a lot of money on it. If interest rates go up, bonds or savings accounts might seem like better ways to spend money because they give back more money. When interest rates are going up, people who invest in real estate should think about whether it's better to put their money in real estate or in other businesses that could make them more money. This is called opportunity cost, which means thinking about what you might miss out on if you choose one thing over another. Navigating the decision. Key considerations. When you think about buying real estate when interest rates are going up, there are both good and bad things to think about. But before making a decision, buyers should think about a lot of different things. How the market is doing, where the property is, what the owner wants to get out of it, and how much risk they are willing to take are all very important factors in deciding if it's a good idea. For investors to make the best choice, they should do a lot of studies, keep up with how the economy is doing, and talk to financial experts. All of these things can help buyers deal with the problems that come with buying real estate when interest rates are going up. That's all for today. I hope you understand both points, but if you still have any questions in mind, you can ask in the comments section. Give this video a big thumbs up and follow us for more interesting videos. Thank you.